Right, for the latest in the world of business this afternoon, the local index and rand are still scuffling to secure lost gains. Khanyisa Ngesi, who's head of investment solutions at Absa Private Wealth Banking, joins us now to dissect the latest inflation data, company news, and the latest monthly BankservAfrica Take-home Pay Index. A very good afternoon to you. Thank you so much for your time, Khanyisa. The rand remains sluggish so far today. When are we likely to see a reprieve there?
Afternoon, Mpho. Sluggish to flat to actually slightly up against major crosses being the dollar, the pound, and the euro. Look, I think the market is waiting with bated breath to see what the Fed is going to do today with regards to holding rates steady for the fifth consecutive meeting. And attention is obviously going to shift to the central bank's projections. I think most importantly, what we want to see is a summary of the economic projections that they have that will reveal whether the very robust data that we're still seeing coming out of the U.S. is going to give officials cause to dial back intentions to cut rates, or whether their outlook for three reductions this year remains on track. So I think if Jerome Powell can stick to a hawkish type script and the message remains consistent, the market reaction will be limited. But if he veers from that script and delivers a more dovish tilt, then I think we'll see not only a violent market reaction, but also a reaction with regards to the rand as well.
Inflation quickened for a second consecutive month, rising to 5.6% in February from 5.3% in January and 5.1% in December. Talk us through some of the highlights and what drove this increase.
Well, that 5.6% is actually above what consensus was expecting, which is 5.5%. It is the highest level we've actually seen in the last 4 months. However, still well within the Reserve Bank's target range of between 3 and 6%. The major contributors to that 5.6 annual inflation rate is transport, which actually increased by 5.4% year on year and was a significant contributor to this number, as well as housing and utilities. I mean, we know what rates and electricity, etc., have done to household consumer expenditure with regards to the significant increases that we saw in the middle of last year. With regards to miscellaneous goods and services, also increasing by 8.4% year on year, and food and non-alcoholic beverages increasing by 6%. So I think obviously the concern going forward is, yes, this print is still within the Reserve Bank's range, but the sticky inflation to the upper end, what does that actually mean for the rate cuts that are widely expected by the market in the second half of this year?
Yeah. The monthly BankservAfrica Take-home Pay Index experienced another positive month in February, which resulted in companies increasing their employees' average salaries over the last 3 months. Perhaps the question should be, at what rate?
In a perfect world, it should be at least at inflation, right? So that we as consumers and citizens can at least tread water with regards to being able to keep up with inflation. But we know that we don't live in a perfect world, and the business environment has been significantly hampered in the last few years, specifically last year, where we saw very minimal economic growth. It is expected to improve this year. But if you look at that BankServ Take-home Pay Index that you are referring to, it actually tracks the average and nominal take-home pay among 4 million salary earners in South Africa. It did pick up in February. It reached just over 16,000 rand, which is about 4.6% up on a year ago. And in real terms, take-home pay actually tracked higher at just over 14,300 rand. So it's still early days, but I think how to interpret this data is that 2024 could be a slightly better year for salaries. The business environment is expected to improve somewhat compared to the last previous years. And I know that obviously there's been ongoing economic challenges that have significantly hampered the ability of companies to pay inflation-related in salary. So even though, as I said, economic growth is expected at 1.3, which sounds mediocre, but at least it's better than the 0.6% growth that we saw in our economy last year, on the assumption, obviously, that there's going to be notably less load shedding this year, and there's going to be a moderation in inflation, and a potential start to the interest rate cutting cycle, albeit in a more measured cycle is foreseen.
Yeah. On the other end, the Discovery says normalized operating profit increased 13% to just over 5 million, while headline earnings were largely unchanged at just over 3 million. Help us make sense of that performance.
Yes, and Paul, so the normalized profit for Discovery from operations increased 13% year on year. This is actually at the midpoint of what they had initially guided. Vitality Global's normalized profit also increased 71% due to a significant increase in Ping An. If you look at their new business annualized premium income also increasing by 28% year on year, but no surprises there. This was communicated. I think the most important thing maybe to highlight in terms of this result, where, for example, they generated about 1 billion rand of IFRS cash from operations and a negative 91 million rand shareholder free cash flow, is that Discovery will only re-rate when the market is confident that they can generate cash earnings sustainably, and to also show that their cash yield can improve. So I think if they can show an adequate cash earnings yield and actually show the market that they are a return-generating bank, and in addition to that, Discovery ensures profitability also should improve, I think this will be quite a nice catalyst for them to re-rate. They've also guided to a dividend cover ratio of 5 times, but only expect to pay about 30 to 40% of the total dividend interim.
In other company news, Investec has their pre-close trading update and trading statement out today. What stood out for you?
A few things stood out, Paul. So as you said, 11 months ended 29th of February. They have actually highlighted that with regards to the depreciation in the currency, specifically the rand against the pound, which was significant, about 15% for this 11-month period. It actually resulted in quite a difference between reported and annual currency performance. There have been quite a few strategic actions that have taken place during this 11-month period, which actually resulted in the performance being presented or guided rather. And a couple of those are the combination of Investec wealth business with Rathbones. They've also embarked on a £300 million share buyback and share repurchase program. They've disposed of a property management company. They've restructured a business in the prior year, and the distribution of the group's 15% shareholding in 91 as well. So those are some of the things that I think are highlights in terms of what they're guiding here. From an earnings perspective, they've given us some numbers. Adjusted earnings per share growing 16% ahead of the prior year. And they've also highlighted a few things with regards to the South African business, where it's expected to grow by at least 10%. Relative to the prior year. Yeah. Maybe two things I'd like to highlight was revenue growth as well supported and quite strong. And they are also saying that, look, given the challenging macroeconomic conditions and the elevated interest rate, they've seen some client stresses, but there isn't really much evidence to say that there's a significant deterioration in the overall credit quality of their lending book. So a strong update from Investec.
Very well. Thank you so much for that very thorough breakdown. Khanyisa Ngesi, who's Absa Group Investment Solutions Head, giving us a sense of how the markets are faring this afternoon.